Welcome back to Accounting 102. In this video, we're going to talk Chapter 7, Incremental Analysis. The learning objectives for Chapter 7 are describe management's decision-making process in incremental analysis, analyze the relevant cost in accepting an order at a special price, analyze the relevant cost in a make or buy decision, analyze the relevant cost and revenues in determining whether to sell or process materials further, analyze the relevant cost to be considered in repairing, retaining, or replacing equipment, and finally analyze the relevant cost in deciding whether to eliminate an unprofitable segment or product. Looks like a lot of data that we're going to cover, a lot of information, but as you'll see as we go through, kind of the analysis is the same, pretty much, looking at, do I do A or B type of thing. So it's the same setup that we have. So we're going to repeat a lot of the stuff and looking at these different things. These decisions are decisions that businesses make all the time. So a good accountant, management accountant especially, that understands how to analyze these costs and revenues to help determine the best decisions is going to be very successful. So making decisions is important in management function. It does not always follow a set pattern. Decisions vary in scope, urgency, and importance. Steps usually followed in process include: 1. Identify the problem and assign responsibility. Determine and evaluate possible courses of actions. Make a decision. And then finally, review the results of the decision. So it's always good to, we sometimes call it a postmortem or a kind of a follow-up review after a decision is made, is in place. Was it the right decision? If it was, then you're good and you can continue to do the same thing. If it was a bad decision or you were missing some data or something, you can use that to inform the next decision. So we're going to consider financial and non-financial information. Financial information are revenues and costs, and effect on overall profitability. That's what we're going to focus on in this course and in this chapter. But there's non-financial information that needs to be considered as well as a company makes decisions. The effect on employee turnover, employee engagement, how satisfied employees are, that type of thing. The effect on the environment. How does any one decision impact the environment over another decision? And then the overall company image. It might be a good thing to do for the company, but if it makes us look bad, we may end up losing customers in the long run, or damaging our reputation, that type of thing. Incremental analysis approach is when decisions involve a choice among alternative actions. It's a process used to identify the financial data that change under alternative courses of action. So it could be where both costs and revenues may vary, or only revenues may vary, or only costs may vary. So it could be any of those. The way we look at that basically is we have our revenues, our costs, our net income. Okay, what's alternative A? How much revenue do we have? How much cost is there? What's our net income? Compare that to alternative B. And then that last column is just the net increase or decrease. So incremental revenue is less under alternative B, $15,000. So that's what that first line is saying. But the cost savings is more. So we have less costs under alternative B. So even though we have lower revenue, we have less costs. So alternative B actually produces $5,000 more net income. So if we're just on a financial basis faced with these two decisions, we should pick alternative B because it provides more net income. Important concepts that we're going to talk about are relevant costs and revenues, opportunity cost, and sunk cost. Okay, and we'll get into what all that means as we see those in examples. Other items to consider: sometimes involves changes that seem contrary to intuition. Variable costs sometimes do not change under alternatives. Fixed costs sometimes change between alternatives. So we have to be careful and understand all of our different types of costing that we've been learning about and understand what changes under which alternative. So the common types of decisions: we accept and order at a special price, make or buy component parts or finished products, sell products or process them further, repair, retain, or replace equipment, eliminate an unprofitable business segment or product. Again, that ties pretty closely to our learning objectives that we just saw, and we're going to be using pretty much the same analysis, slightly different in each one, but we'll get through those examples. So we're just applying that analysis to different decisions. So review question. Incremental analysis is the process of identifying the financial data that A, do not change under alternative course of action, B, change under alternative courses of action, C, are mixed under alternative courses of actions, or D, none of the above. And the answer is B. It's identifying the financial data that change under alternative courses of action. All right, let's do a incremental analysis together. So O&T Corporation is comparing two different options. The company currently operates under option 1 with revenues of $80,000 per year, maintenance expenses of $5,000 per year, operating expenses of $38,000 per year. Option 2 provides revenues of $80,000 per year, maintenance expenses of $12,000 per year, and operating expenses of $32,000 per year. Option 1 employs a piece of equipment that was upgraded 2 years ago at a cost of $22,000. If option 2 is chosen, it will free up resources that will increase revenues by $3,000. Complete the following table to show the change in income from choosing option 2 versus option 1. Designate any sunk costs with an S. So here's the table that we're going to fill out. We have our two options, our net increase or decrease between the two, and identifying what are sunk costs. We have revenues, maintenance expenses, operating expenses, cost of past equipment upgrade, and the opportunity cost. Okay, and that opportunity cost is that cost that they talked about, that if we choose option 2, it frees up resources for additional profit, that we can make something different. So if we fill out the option 1 column, we had revenues of $80,000, maintenance expense of $5,000, operating expenses of $38,000. The cost of past equipment upgrade was $22,000, and our opportunity cost of $3,000. Okay, we show that as a cost in option 1 because only in option 2 are able to realize that profit. So we show it as a cost in the other option. Okay. Option 2, we have the same revenue, $80,000, maintenance expense of $12,000, operating expenses $32,000. Cost of past upgrade, it's a new option, so we don't have that past upgrade. And the opportunity cost, again, we talked about that, it belongs in option 1 because if we choose option 2, we'll get that benefit. So now we just look at the differences, see if there's a net increase or decrease. Revenues are the same. Maintenance expenses, $7,000 higher under option 2, so it's going to decrease our income by $7,000 if we choose that option. Operating expenses, $38,000 under option 1, $32,000 under option 2. It's actually $6,000 better if we choose option 2. Now this cost of past equipment upgrade, this is what we're going to call a sunk cost. It's a cost that happened in the past. It has no relevant, it's not relevant in our decision making as of now. It's sunk. It's done with. We can't do anything about it. Okay. Opportunity cost, again, we said if we choose option 2, we will be able to do something with that capacity to generate additional income. So it shows as the opportunity cost in option 1, not in option 2, so we have a benefit. And then if we just add up that column, we see doing option 2, we're going to increase our income $2,000. So based just solely on financials, we should do that option. Now we'll look at similar analysis, but look at it at special order pricing. So to obtain additional business by making a major price concession to a specific customer, assumes that sales of products in other markets are not affected by a special order, assumes that company is not operating at full capacity. Okay, which means that we have capacity to take on that order without having to do anything else. So we're going to look at incremental things. So Sunbelt Company produces 100,000 smoothie blenders per month, which is 80% of factory capacity. Okay, we're only running at 80%, so we have capacity to make more. Variable manufacturing costs are $8 per unit. Fixed manufacturing costs are $400,000 or $4 per unit. Smoothie blenders are normally sold directly to retailers at $20 each. Kensington Company, a foreign wholesaler, has offered to purchase an additional 2,000 blenders from Sunbelt at $11 per unit. Okay, so it's $9 less than we normally sell it, but we'll go through the analysis to see if it makes sense. Management has determined that acceptance of the offer would not affect normal sales of the product, and the additional units can be manufactured without increasing factory capacity. What should management do? So we're going to look at analysis similar to what we just did, but in this case we have reject and accept. If we reject the order, we get no additional revenues, there's no additional costs, so no additional net income. If we accept the order, we have $22,000 of additional revenues, so $11 per unit times the 2,000 units. The costs are the 2,000 units at our variable cost. So if we go back, it's $8 per unit is our variable cost. So we're going to take that into account. So that's $16,000 for those 2,000 units. We're not changing fixed costs, so they're not relevant in this analysis. It's just the variable costs that are changing, that would increase when we do this. The fixed cost will still be the $400,000 that we saw on the previous slide. The amount per unit, if we were to analyze that, would change because we're producing more units, but the total cost doesn't change. So if we accept the order, we can generate $6,000 more of net income. And again, we're just looking at the incremental revenue, the variable manufacturing costs, because that's what's relevant. So let's do another one. Cobb Company incurs costs of $28 per unit, 18 variable and 10 fixed, to make a product that normally sells for $42. A foreign wholesaler offers to buy 5,000 units at $25 each. The special order results in additional shipping costs of $1 per unit. Compute the increase or decrease in net income Cobb realizes by accepting the special order, assuming Cobb has excess operating capacity. Should they accept it? So again, our table has reject, accept, and then what the net income increase or decrease is. If we reject the order, no additional, so it's 0. If we accept it, we're going to sell 5,000 units at $25, so we'll have $125,000 of revenue. Okay. Our costs are going to be our $18 variable. So we're just going to again look at variable, not fixed cost, just our variable cost. So 18 times 5,000 plus the additional $1 in shipping costs. So 5,000 times 18 plus $5,000 at $1, so $95,000. Our net income then increases by $30,000. If we look at the total again, $30,000 increase if we accept the special order. So this analysis indicates net income increases by $30,000, therefore we should accept the special order. Now let's look at the relevant costs in a make or buy decision. So Bayer & Company incurs the following annual costs in producing 25,000 ignition switches for motorcycles. So we have direct materials, direct labor, variable overhead, fixed overhead, total manufacturing costs of $225,000. We make 25,000 switches, so $9 per unit. Instead of making the switches, Bayer might purchase ignition switches at a price of $8 per unit. It's $1 cheaper than we're making it, so it might make sense. But if they do this, all variable costs and $10,000 of fixed costs will be eliminated. What should they do? Okay, that fixed cost portion is going to be key here. So if we look at make versus buy, similar setup in our analysis. One column for make, what are our costs? One column for buy, what are the costs if we buy it? Then the change, the increase or decrease to net income. So our make shows our total annual or total manufacturing cost of $225 that we saw in the previous slide. The buy, we're going to purchase 25,000 of these switches at $8 per unit, so that's $200,000. But remember, only $10,000 of the fixed manufacturing costs are eliminated. So we still have $50,000 of fixed manufacturing costs under the buy scenario. So our total costs are $250,000, which is actually higher than our make. So if we look at each line, did it increase or decrease net income? It all increases net income until we get to the purchase price, $200,000 decrease. It's a net decrease in net income of $25,000 if we buy. So even though manufacturing cost is higher per unit than the purchase price, with that fixed cost not going away, it's still going to cost us more to buy. So a review question. In a make or buy decision, relevant costs are manufacturing costs that will be saved, the purchase price of units, opportunity costs, or all of the above? And the answer is all of the above. So opportunity cost is the lost potential benefit that could have been obtained from following an alternative course of action. If there's an opportunity to use this productive capacity in some other manner, then this opportunity cost must be considered. So let's look at that a little bit more. Assume that through buying the switches, Bayer & Company can use the released productive capacity to generate additional income of $38,000 from producing a different product. Lost income is an additional cost of continuing to make the switches in the make or buy decision. Okay, so we took the total from our previous analysis that we did that showed that the buy is $25,000 more expensive than making it. But now we're going to add this opportunity cost to the make because we're giving that up by continuing to make our make the product ourselves instead of buying it. So it's a cost as part of making it because we don't have that excess capacity or that free capacity. Okay, so if we include that, our total cost for making is $263,000. Buying is still the $250,000, so actually we increase net income by $13,000 if we buy it. So as long as we can generate additional income of $38,000 from that released productive capacity, then we should buy and make that switch. So Oneida Company must decide whether to make or buy some of its components for the appliances it produces. Cost of producing 166,000 electrical cords for its appliances are as follows. So we have direct materials, direct labor, variable overhead, and fixed overhead. Instead of making the electrical cords at an average cost per unit of $1, so $166,000 is the sum of those four divided by the 166,000 cords they make. The company has an opportunity to buy the cords at 90 cents per unit. If the company purchases the cords, all variable costs and 1/4 of the fixed costs are eliminated, should they make or buy. So we'll do our analysis. Again, we have our make column or buy column. So $166,000 total cost for making. Our buy column has purchase price of $149,400, which is the 166,000 cords times 90 cents. We have fixed manufacturing cost of 75% of the make, so 24,000. We can eliminate a quarter, it said in the previous slide, so we still have 75% of that. So that totals 167,400, which is 1,400 more than making it. So in this case, Juanita should make the components. Now, will your answer be different if the released productive capacity of the production facility will generate additional income of $5,000? So again, we take that last total line that we had from the previous slide. So 166 make, 167.4 to buy. Now we have an opportunity cost of $5,000 of income that we add that cost to the make because we're giving that up by continuing to make it. So that's 171,000 compared to the buy 167,400. So our net income increase is 3,600. So yes, the answer is different. The analysis shows that net income increases by that 3,600 if they purchase, so they should buy the components. Now we'll look at determining whether to sell or process materials further. So companies may have an option to sell product at a given point in production or continuing to process and sell later at a higher price. So we have a decision rule here that we process further as long as the incremental revenue from such processing exceeds the incremental processing costs. Okay, so we're going to compare the price at point A, the incremental price going further to point B, and then what's that extra cost to get us from point A to point B. So that's going to be our analysis. So Woodmasters makes tables. The cost of manufacturing an unfinished table is $35. Selling price per unfinished unit is $50. Woodmasters has unused capacity that can be used to finish the tables and sell them at $60 per unit. For a finished table, direct materials will increase $2, direct labor cost will increase $4. Variable manufacturing overhead costs will increase by $2.40, which is 60% of direct labor. No increase is anticipated in fixed manufacturing. So this chart shows our current manufacturing cost per unit to make the unfinished table. So we said it was $35. Here's how we got to that $35. Direct materials, direct labor, variable overhead, fixed overhead, and that total is $35 per unit. Then we can do our analysis to compare the two. If we sell unfinished, selling price is $50. We have all our costs $35, $15 net income per unit. If we process further, $60 the selling price. Direct materials will increase by $2 to $17. Direct labor increases $4 to $14. Variable manufacturing overhead increases $2.40 to $8.40. Fixed manufacturing overhead stays the same. So we have total cost of $43.40. So $16.60 net income, which is $1.60 higher than the unfinished. So we should process further. Okay, so that's just comparing what is my income if I sell it unfinished, what is my income if I process further. Joint production process, so a creamery in this case. So cream and skim milk are products that result from the processing of raw milk. So we have raw milk from the cow, we have common processes, and the cost of that we call joint costs, and then we're at a split off point. Okay, we can take cream, process further, and make cottage cheese and then sell that. We have skim milk coming out of the common processes. We could process that further, make condensed milk, and sell that. So joint product costs are sunk costs and thus not relevant to the sell or process further decision. Okay, again, sunk costs, we don't worry about them in the incremental analysis that we're doing. So cream, joint cost allocated to cream, $9,000. Again, that's not relevant. And what do we do next? Because it's a sunk cost. We've got the cream already, so the cost of that isn't really relevant. We have cost to process the cream into cottage cheese of $10,000. If we sell the cream, we get $19,000. If we sell the cottage cheese, it's $27,000. Determine whether the company should simply sell the cream or process it further into cottage cheese. So now we're in a sell or process further analysis. So we take our sales, $19 to sell the cream. There's no additional costs because we're not doing anything else to it. We already have the cream. So it's $19,000 per day. Process further, we increase sales $8,000 to $27,000, but our costs are $10,000, so an increase of $10,000 in costs, so $17,000 in income. So we're actually have $2,000 less income per day to turn it into cottage cheese, so we should not process the cream further. Now if we look at the other split off, skim milk, we have skim milk, it costs $5,000 to get us to skim milk. Again, that's not relevant. We're just going to look at the incremental. So the cost to process skim milk and to condense is $8,000. Skim milk sells for $11,000. Condensed milk sells for $26,000. Determine whether the company should sell the skim milk or process further into condensed. Again, if we sell the skim, no additional cost. We just $11,000 is our income. If we process further, our sales increase $15,000 to $26,000 per day. Our costs increase $8,000. So we have $18,000 of income per day, which is an increase of $7,000 over selling the skim milk. So we should process further and sell the condensed milk. Now, a review question. Process further as long as the incremental revenue from processing exceeds A, incremental processing cost, B, variable processing cost, C, fixed processing costs, or is it D, that no correct answer is given? The answer is incremental. As long as the incremental revenue exceeds their incremental processing cost, we should process further. We'll go through another example. Easy Dozen manufactures unpainted furniture for the do-it-yourself market. Currently sells a child's rocking chair for $25. Production cost per unit are $12 variable, $8 fixed. Easy Does It is considering painting the rocking chair and selling it for $35. Variable costs to paint each chair are expected to be $9, and fixed costs are expected to be $2. Prepare an analysis showing whether they should sell unpainted or painted chairs. So if we sell the unpainted, we get $25 per chair. Our costs are 12 variable, 8 fixed, so we have 5 net income. If we process further, revenues go up $10 per chair. Variable costs increase $9 to $21. Fixed costs increase $2 to $10. So our net income is only $4, which is $1 less than the sell. So we should sell the unpainted and not process further in this example. Now let's look at relevant costs considered repairing, retaining, or replacing equipment. So Jeffco Company has a factory machine that originally cost $110,000. It has a balance and accumulated depreciation of $70,000. So the machine's book value is $40,000. It has a remaining useful life of 4 years. The company is considering replacing this machine with a new machine. The new machine is available that costs $120,000. It is expected to have 0 salvage value at the end of its 4-year useful life. If the new machine is acquired, variable manufacturing costs are expected to decrease from $160,000 to $125,000 annually. And the old unit could be sold for $5,000. Prepare the incremental analysis for the 4-year period. So since we're doing this for the 4-year period, for variable manufacturing cost, if we retain the equipment, we take the $160,000 times 4 to get $640,000. If we're going to replace the equipment, that variable manufacturing cost decreases to $125,000. So we have 4 years at $125,000 is $500,000. So $140,000 benefit. But we're going to buy a new machine at a cost of $120,000. But we get to sell the old machine for $5,000. So we're going to reduce our cost of replacing the equipment by that $5,000. $615,000 total. So we should replace the machine because our net income will increase $25,000 based on our incremental analysis. Now, suppose the manager spent $90,000 repairing a machine 2 months ago. The amount spent to repair the machine is irrelevant to the current decision. Okay, so it's a sunk cost. So costs which cannot be changed by future decisions are sunk costs, and they're not relevant in incremental analysis. Any trading allowance or cash disposal value of the existing asset is relevant because that's an incremental thing that's going to happen. So Rochester Roofing is faced with a decision. The company relies very heavily on the use of its 60-foot extension lift for work on large homes and commercial properties. Last year, the company spent $60,000 refurbishing the lift. It has just determined that another $40,000 of repair work is required. Alternatively, Rochester Roofing has found a newer used lift that is for sale for $170,000. The company estimates that both the old and new lifts would have useful lives of 6 years. However, the new lift is more efficient and thus would reduce operating expenses from $70,000 to $50,000. The company could also rent the new lift to other contractors for about $2,000 per year. The old lift is not suitable for rental. The old lift could currently be sold for $25,000 if the new lift is purchased. Prepare an incremental analysis that show whether the company should repair or replace the equipment. So when you first look at this, we repair for $40,000, or we buy newer used for $170,000. Well, should we spend that extra $130,000? That's what we're trying to figure out. Okay, they have the same useful life. We're going to save some money because the new lift is more efficient, and we can rent it out. We can sell the old one. So if we do the analysis, we have $420,000 of operating cost, 6 years of $70,000, $40,000 as repair cost, $460,000 total. If we replace it, Our operating costs go from 70 to 50 per year. For 6 years is 300,000. We don't have the repair costs. We're going to have rental revenue of $12,000, $2,000 a year. That's going to decrease our cost on the replace column. 170 for the new machine. We get $25,000 for selling the old machine. So our net is $433,000 if we replace it, which is less than retaining the equipment by $27,000. So this analysis indicates purchasing the new machine is better because it's going to increase net income for the 6-year period by $27,000. And finally, we'll look at analyzing the relevant cost and deciding whether to eliminate an unprofitable segment or product. So the key is to focus on relevant costs. Consider the effect on related product lines. Fixed cost allocated to the unprofitable segment must be absorbed by the other segments. Net income may decrease when an unprofitable segment is eliminated. And the decision rule is to retain the segment unless fixed cost eliminated exceed the contribution margin lost. So we'll go through examples and see what that really looks like. So Venus Company manufactures 3 models of tennis rackets. We have the Pro, Master, and the Champ. The Pro and the Master are profitable. The Champ is unprofitable. So the question is, should we get rid of the Champ model since it's unprofitable? If we look at the income data after eliminating Champ, we assume that fixed costs are allocated 2/3 to Pro and 1/3 to Master. And our net income is $210,000, which is actually $10,000 less than what it was with the Champ. Okay. The key thing that happens here is that even though we have a minus 20, we have a loss here, we have $30,000 of fixed cost that the Champ is assigned to the Champ line. So our total fixed cost, just by eliminating that model, doesn't change. We just have to reallocate it to the remaining products. So that $160,000 that we see here for fixed cost, when we go look at it without that Champ, we still have that $160 of total fixed costs, just reallocated. So our total net income decreases if we do that. If we do incremental analysis of continuing or eliminating this, like we've seen before, we get to the same result. So if we continue, we'll have our sales, our variable costs, our contribution margin, our fixed costs. We have a net loss, but if we eliminate it, we don't have that variable contribution, or we don't have that contribution margin, but we still have the 30,000 fixed costs. So we actually have more cost, a bigger loss if we eliminate it than if we continue it. Now assume that $22,000 of the fixed costs attributed to the Champ line can be eliminated if the line is discontinued. That looks a little bit different. So we have our continues the same, a loss of $20,000. If we eliminate it, our fixed costs go from $30,000 down to $8,000. So we're actually $12,000 better. So if we can eliminate that much of the fixed cost, we should eliminate that segment. So if an unprofitable segment is eliminated, A, net income will always increase. B, variable expenses of the eliminated segment will have to be absorbed by other segments. Fixed expenses allocated to the eliminated segment will have to be absorbed by other segments. Or net income will always decrease. And the answer is C, the fixed expenses must be allocated to the other segments. So Lambert Incorporated manufactures several types of accessories. For the year, the knit hats and scarves line had sales of 400,000, variable expenses of 310,000, fixed expenses of 120. Therefore, knit hats and scarves had a net loss of $30,000. If Lambert eliminates the knit hats and scarves line, $20,000 of fixed costs will remain. Prepare an analysis showing whether the company should eliminate the knit hats and scarves line. So if we continue, we have our sales and our costs that we just outlined, so a loss of $30,000. If we eliminate it, we only have the fixed cost of $20,000 remaining. So that's a better option to eliminate it because our net income will increase by $10,000. In this analysis that we've done here, and this last part can be done for products, can be done for product lines like this knit hats and scarves, could be done for whole divisions. So all of those will use the same type of analysis. And we've kind of used that same analysis for all these different decisions that could be made, just looking at the relevant costs and what the incremental changes are from one decision to another. That's it for Chapter 7. Reach out if you have any questions, and that's it.